Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the second webinar in our 2023 veterinary series titled Drive Practice Growth with the top KPIs you need to track. We're excited to bring another year of interesting topics and encourage you to sign up for the other webinars in the series. I'll have more info on those towards the end. But before we get started, I just want to take a sec and say a few words about SVA and our history working with veterinarians. Like many of you, we got to where we are by being independent. And our vision moving forward is to remain that way and continue serving the same clients we have since 1974. And a huge part of that client base over these last now almost 50 years, as you can see from my new background, is within our healthcare practice, which includes medical, dental, and of course, veterinary. Our mindset is that when you're a practice owner or shareholder or practice manager, you have to work with someone who's more than just an accountant or tax preparer. You need someone who's a true advisor working collaboratively with you. This webinar and others like it are just small ways in which we do that. As far as this webinar goes, please send in any questions you may have as we go, but we'll wait until the end to answer them. If you're a client and your question doesn't get answered, we'd encourage you to reach out to your SVA contact. If you're not a client and have questions, please reach out to me or John Armstrong in our business development group, and we'll make sure one of our subject matter experts gets your questions answered. Well, this isn't going to surprise you. We've got two of our most experienced people in our healthcare group to walk you through everything today. First off, we've got Andy Slinger, a principal who really has led our vet practice now for several years. And we have Nate Drykosen, a senior manager in our healthcare practice who works with practice owners and practice managers on efficiency and profitability strategies. So let's jump in. I'm going to kick it off to Andy to get us started.
Awesome. Thank you, Lee. Thank you, everybody, for joining us. It's very exciting to see so many both familiar faces and on the registration list, and a lot of faces and names that we're excited to hopefully meet someday. Very important point, as Lee mentioned, this is the second in our series, and we're going to reference the first webinar. And we encourage you that after hearing about how the first webinar leads into this one, if you want to go back and reference the first, we will certainly give you guidance on how you can go back and watch that first webinar from September. So before we get started, I like to start with why. Why are you here and why are we here presenting you this content, okay? The call to action. Some of you, we've heard, hey, you've got a lot of cash, more cash than you ever had in your practice. I'm drawing a paycheck. My patient appointments are full. I'm in great shape. That may be true, but we're here to help you get to that next level. A lot of you will say this is the golden era of my vet practice. I want to maximize the return. I want to get this thing ready for sale. I want to evaluate a practice that I'm considering purchasing. I'm a startup. I took a risk. I want to see how I'm doing, and I want to grow quickly. I'm expanding. Or you know what? I'm a mature practice. Wherever you are in your vet life cycle for your practice, we want to give you a call to action today. Basically, we're going to introduce you to some common key performance indicators, okay? Certainly not an exhaustive list. We're going to start with what we feel are a lot of the most common and maybe some of those that can most quickly move the needle for you and where you want to go. Next, we're going to look at how you measure and interpret the results. We're not just going to throw numbers at you, because the next thing you're going to say is, what does that mean? We're going to say exactly what the numbers mean relative to your type of practice and where you are. But then most importantly, what I'm excited about as we go through this content is we're going to give you strategies to improve your practice health, your profitability, your patient experience, and I'll even add one. I think it really improves the culture of your practice and just makes it a very exciting place for both patients and your staff to come to. Okay, so now we know where we want to go with the presentation. What are the keys to evaluating key performance indicators? Okay, now this will be the first time that I reference our first webinar. First of all, key performance indicators have to be accessible. Okay, so a lot of times, again, we ask practice owners, Do you know your numbers? No, I don't even know where to get them. And this could be internal or external. You may be so busy, or your accounting staff internally is so busy that you always feel you're getting your data behind, or you're outsourcing or using an external provider. Same thing. If you don't know your numbers, if you don't know where to find the input that goes into calculating the KPIs, that's going to be your first step, as we'll address as we move forward. Also, you may have numbers, but are they accurate? Again, the output's only as accurate as the input. Okay, so is the data accurate? Is it timely? I just alluded to that. Are you making decisions that are months or quarters or even more than a year old at this point? Or are you on top of your information so that you can make very important decisions on the fly and measure the changes that you're making and the effect and the effectiveness of them? The other thing is they got to be relevant, okay, and insightful. Are the key performance indicators that you consider, do they apply to your practice and where you are right now? Will they move the needle? And the other thing to consider is, the timeline. 2 examples. If you're measuring a period where you didn't have an associate and now you do, you got to be careful. And then the other one is, maybe your patient mix and your population has changed over the years. You have to measure that and make sure the KPIs are relevant. Point being today, there's so much to choose from. And it depends on your practice size, the type, your population mix, your strength. It says weaknesses, I like to call them opportunities. But today in 25 minutes, it's really just to start the conversation that you can then build upon. Okay, moving right along. Very high level. What are we going to drill into? Okay. Maybe the biggest one, revenue, right? Essentially, someday you buy, sell a practice. So much of that and so much of what goes into your EBITDA that we're going to talk about starts with your top line and the health of your top line. And that can be both fees and that can be markup on what goes into those procedures, the products. Delicate issue with vet owners, what you charge. And so independent vet owners. And so we really want to highlight that and show you how you can move the needle in your practice. Efficiency. This can be with your staff. This can be your time with the patient. This can be the overall flow in the practice. Your costs. As you know, everything costs more than ever. Okay. And so inventory management, staffing, cost of sales, lab, etc., that can have a big effect on the measurement of your practice. And last but not least, it's your planning future goals. Is your practice what you think it's worth, whether you're looking to buy something or sell something? What is an external third party going to come in and think and interpret? They're going to look at a lot of these same metrics when they're evaluating your practice. So this gets you on the front end, no matter if you're looking for growth, if you're considering bringing on an associate, if you're considering an expansion, this will just help you to measure the health of your practice. Okay, let's set a few ground rules and just kind of set some assumptions here for you. Some of you may have been with us back in late 2021 when we put on a similar presentation. Got to tell you, so much has happened in the last 3 years. So much data has come out. We've had so many conversations with vet practice owners and been involved in so many purchases and sales. We have a lot of data. And so you will find this presentation to be so much more robust, so much more detailed than last time. Please know that depending on if you're small or large, most of the questions we field relate to small animal practices. So again, you will find that presentation tailored to small, but we will delineate some large animal metrics. And of course, last but not least, you probably have 3 sets of data: small, large, or you could be a mixed practice. So while there are some synergies, you'll find that in many cases, it is a combination of different metrics if you're a mixed practice. Okay. So now time to turn it over to the person I like to call our encyclopedia of KPIs and benchmarking. I would say almost on a daily basis, I am talking to Nate, and as I'm evaluating and talking to a practice, I ask him for his opinion on how we can, change some KPIs. So Nate, take it away.
Thanks, Andy. I think we'll kind of break these KPIs down into a couple broad categories and start with some of the more accessible ones that really are available with any practice software, provided you take the time to track them, and then eventually move on to some of the more financially nuanced KPIs. First one being number of invoices. That can really vary depending on the practice, but kind of a good rule of thumb is anywhere between 4,600 and 4,800 per veterinarian is kind of a good place to start in terms of overall volume. Average invoice, again, can really vary depending upon specialty and services offered. So it really geared toward the services you offer within your practice. And the next one is new patients. It's important to realize how busy you are with the number of invoices. Are you charging appropriately and adjusting for growth with the charge per invoice? And how many new patients are coming in the door? Is your practice growing or is it more mature? So as we dive into more of the financially nuanced performance indicators, the first one, maybe the most important, arguably the most important, we like to look at is the revenue per veterinarian. So this gives us insight on a few different topics based on the inputs that kind of go into this revenue. And what we're taking a look at here is simply the top line revenue from services and retail associated with the veterinarian and with veterinarians, and then dividing that by the number of full-time equivalent veterinarians within a practice. This gives you some insights on how the doctors spend their time, if they're being efficient. Also some insights on pricing, making sure that your fees and your prices are fair and adjusting with inflation in the times. And we tend to see these in a couple different categories for small and large animal. A good metric to use would be at least 700,000 for small animal, 750 being a really good number, and oftentimes we see the best, most efficient practices at 850 plus. And on the large animal side, just because of the nuances with servicing large animals, like to see at least 250,000, would certainly see some well above 375,000 per veterinarian at the high performing level. I will say the caveat with the large animal, some of the dynamics, oftentimes it really relies on geography and the number of support staff associated with the practice. So taking that a step further, going beyond the veterinarians, looking at how you leverage your staff. You've got folks of various different positions, and how efficient do they work together to support the veterinarians and also the techs as well, the folks that are seeing patients, hopefully quickly and efficiently. We call this staff leverage. How are you using your staff effectively? Are they spending more time doing administrative functions versus successfully supporting clinical providers to get through patients and billing and those sorts of things? One reason we like the revenue per non-DVM staff metric is a lot of times in the industry, you'll see a staff to DVM ratio of somewhere between 1, 1.3, 1.11, 3.5, somewhere in that neighborhood. But really in our practice, we see lots of clinics that are successful with ratios as high as 7 employees per DVM, as much as we see the 1 to 3, 1 to 3.5 metric. And what this really gets at is it's kind of okay to have more employees for DVM so long as you're leveraging them successfully. And this metric can kind of adjust for that, for the comparability between the dynamics within a practice and staff. Ultimately, we like to see at least 190, but high performing would be well over 215 for small animal, and large animal anywhere from 100 to 125 being high performing, being a realistic goal for this metric. So great, we've got these two revenue per staff metrics. So what do you do if this utilization is unfavorable? Well, the first thing you want to look at is look at the variables. The first part of this is revenue. The other part is your time. And this could be unfavorable for a few different reasons. It could be because you need to adjust your fees. It could be because maybe your retail is underpriced. It could be that you're not charging enough for lab. It could be that, with all the time you're spending making farm calls, maybe you're not charging appropriately for that time. Maybe geography is playing a factor. The other item to consider would be the time spent with each particular patient. Ideally you want to shoot for in the small animal world, most appointments averaging between 15 to 20 minutes, 30 minutes max. And then the other consideration is looking at roles of responsibilities of your team. What is everybody doing? What could they be doing better? What are ways to free them up to be able to get through patients faster, more effectively? So we've already covered some revenue per DVM. Now we want to look at some particular cost structures as a percentage of revenue. And switching gears to that, think of that as we really only want to consider operating revenues as a part of this. A great example from maybe a few years ago with the pandemic, many clinics were and well-deservedly received PPP loan forgiveness, maybe had some grants to help keep the doors open, keep the staff paid. Those sorts of things really have not a whole lot to do with operations, but they supported your clinic during a time when you needed it. That's kind of a caveat, like Andy said, when we want to consider and weigh different timelines as you track this over time, certainly a consideration you want to weigh. And to echo this again, all of this data is going to rely heavily on good accounting data and good practice software data. Without that foundation, sometimes these metrics and ratios aren't going to make a whole lot of sense. You want to make sure you're taking the time investing in capturing good, clean, timely data for utilizing all these different ways to track your practice health and growth. Maybe one of the most crucial percentage of revenue metrics might be looking at total cost of goods sold as a percentage of revenue. So what goes into total cost of goods sold? That would be any kind of consumable, drugs and supplies, lab. Sometimes clinics have other categories that they track based on their service offerings. You'd want to make sure any direct costs with administering those are captured. And really you want to aim for at least 25% of revenue, but in an ideal world, 21% or less is typically very achievable. So many clinics we work with don't initially start at that range. So what do? The first thing, look at your pricing. Oftentimes, like we've said before, your markups, what you're charging for many of your most common services aren't where they should be. So by increasing your pricing, you increase your denominator for this metric. Making sure that you're purchasing effectively. In an ideal world, you want to have turning over your inventory on hand right around 9 times a year. Don't want to have a lot of spoilage, and you want to make sure that you're costing your inventory appropriately and tracking appropriately within your practice software. So having good staff training in that category is important. The next, maybe largest expense item on most profit and loss statements for veterinary clinics is going to be staff expenses. So looking at non-veterinary staff expenses as a percentage of revenue. As the slide says, a good goal is for wages and benefits is 20%. Now, many clinics don't exactly track and carve out these different nuances. So if you're looking at just payroll, not including payroll taxes and breaking that out between different positions, 18 to 19% is kind of a good number there. And what we're finding is clinics are needing to increase their benefit offerings and wages to help compete for talent. So as you're looking at having to do that for staff, don't forget to revisit the revenue side and adjust your fees accordingly. If nothing else, all that's going to do is slowly erode against the margins and ultimately the health of your clinic. Each year, SVA does a salary and benefits survey. So if you have not participated this year and are tuning in, next year, we definitely encourage you to participate. Ultimately, you'll get a copy of the results, and our clients and those we consult with on this ultimately find a ton of value in seeing these results and comparing how their clinic compares to everybody else, and they use them in their day-to-day operations with compensating their staff. Moving on down the profit and loss statement. Profit before veterinary compensation as a percentage of revenue. And you'll see some of these metrics are getting a little bit more wordy. So we'll try and sum these up as best we can. Really what the calculation looking at is looking at your top line operating revenue, less all of your operating expenses, except for any expenses specific to your veterinarians. So that would be wages, benefits, taxes is the most common ones. And sometimes there's some different quirks with certain expenses that veterinarians, especially veterinary owners, have. Again, good numbers, 30% small animal, with the top practices being right around 34%. Large animal, great numbers to strive for, anywhere from 23 to 25%. On to associates. So these are the folks that oftentimes are the most highly compensated in the clinic. And a lot of times those arrangements can look a lot of different ways, but ultimately a good way to think about how you're paying your associates versus what you're gaining from them is you want to make sure that you're seeing somewhere between 4 to 5 times wages in terms of what their production is, their gross production for a year. All right, so ultimately, what does this mean for you as an owner? How do you know if you're being compensated fairly? And also, how do you compare to your peers? One thing we've realized is that practice dynamics are a little bit different depending upon the number of owners, the number of associates, and also if any of the owners are not practicing veterinarians. So we'd like to look at this as a couple different metrics and kind of view them in tandem. One being profit before owner compensation as a percentage of revenue, the other being profit before owner compensation as a percentage of owner production. So each of these will give insight to different factors that might weigh into a clinic, but some good numbers to strive for in terms of profitability. Small animal want to hit at least 20%. Large animal tends to be more in the 13 to 15%. And some things that could throw this off if associates produce a lot relative to the number of owners, or if the owner is somehow receiving compensation or absorbing some compensation from management duties that other clinics might allocate to full-time positions. So to kind of compensate that or take it with a grain of salt, we also look at profit before owner production. And this kind of adjusts for high-performing associates or maybe owners that are starting to take a step back in their production as they wean down their careers, hoping that the newer folks, the associates, step into that role. And kind of a good top performer number to strive for there is right around 45%. Lastly, we've got EBITDA, the acronym that is thrown around constantly in the veterinary world. So we like to tweak EBITDA a little bit and call it a standardized EBITDA as a percentage of revenue. So EBITDA, as a recap, is earnings before interest, taxes, depreciation, amortization. So what does that mean? That means your operating income, adding back interest expense, take out interest income, add back taxes specific to income. So payroll taxes are still included. You don't want to add those back. Depreciation, amortization, and then importantly, you want to adjust for any non-operating expenses and revenues that might happen. So what does EBITDA do? Why is it so important? EBITDA measures the quality of earnings of a veterinary practice. And what it does is it helps right size a little bit between different stages in life cycle between practices. So younger clinics tend to have a little bit more loans on the books, so they might have higher interest. They might have higher depreciation amounts because they're having to buy all sorts of new equipment and ramp up and also finance a lot of this. Conversely, clinics in the later stages where they're a more mature practice might have a little bit less of that. So we want to take out some of that variability as we're looking and comparing peers in this category. Private equity and consolidators all kind of have their own formula on how they standardize this. So some of the things we've seen is standardizing rent to 6% as a percentage of revenue, but we've also seen it as a percentage of fair market value if your particular situation is where you are also a part owner or owner of the building that houses your clinic. They also adjust veterinarian compensation to somewhere between usually right around 20 to 21% of production. And that's for small animals specifically. Large tends to be more like 19, 20%. And all in all, after making all of these adjustments, some good numbers, concrete benchmarks would be for small animal right around 17%, but 20% being the goal. Large animal more like 13% as an average. So with the alphabet soup and number soup we just threw at you, there's a lot here. Again, we want to just scratch the surface, but to help you out a little bit, we're going to summarize some of the higher level takeaways that you can take with you conceptually back to your practice.
Thanks, Nate. Didn't I tell you he was a walking encyclopedia of information? He really knows his numbers, so thank you. So hard to summarize, a lot of information, but basically last two slides here, takeaways and next steps, kind of all in one. And yes, some repetition, but I like repetition for effect, and I think it's very necessary for this topic. So first and foremost, I know a lot of times we focus on the macro. Some of this is looking at the micro. And yes, 1% matters today, because if you're a $2 million practice, 1% of that is $20,000. And if I were to tell you that a couple small changes get you a $20,000 raise, now I have you listening. Okay, so the micro does matter. You want somewhere to start. I can't tell you how many practices we see and work with that it's their fees that they're charging, that they're just not getting fair value for what they're providing to their patient base. Same with markup. Markup's again a delicate conversation, but start there. That has a trickle-down effect, and a lot of times goes right to that EBITDA number. Okay, it just makes your practice look that much more healthy and attractive. Start small. Okay. We all have different opinions, 1, 2, 3, 4, 5, but start with KPIs if you haven't. And maybe you have been implementing and tracking KPIs, but maybe they're not the right ones. So start, be patient with yourself, and get comfortable, and then move along. I can't stress this enough. I'll say it again as we turn the page, but invest in a process to gather clean, timely, accurate, understandable data. And this is, again, where if you want to see our first presentation from September that talked about an efficient accounting office, either internal or external, Lee and his team can give you a direction on how to access that. Okay, I'll mention your trusted advisor here in a minute. Going to our final slide then. Can't stress it enough. Look at your financial reports, if you have them. Are they timely? Are they accurate? Are they summarized in a way that you could easily use the input to get the output that Nate presented very eloquently in his slides? If not, time to make changes. Is it your practice management software going to your accounting software? Is it your internal accounting function linking with payroll and your bank? Is it your external third-party provider? What's holding you back in knowing your numbers? Once you have it, allocate time to what we like to call working on the business. Step out of working in the business, work on the business, review that clean data once a month or at least once a quarter. Involve your trusted advisors. Get independent observations on what they see in your practice. And again, this is what Nate and I love to do, is just sit and listen to your concerns, what's working, what's not working, and then when the time is right, give you advice on how to really move your practice to where you want to go. And, last but not least, change can be hard, but dive in, make those changes. And if you need a place to start, like I said, address those fees, make sure they're where they should be, make sure you're using your staff efficiently, because as you know, they've never been harder to find, harder to retain, or more expensive. Consider your inventory management. That's your most single expensive expense on your income statement. And, just walk in the shoes of your patient base and look at the experience that they're getting, the culture, see what immediate changes you can make. All right, Lee, that's all we got. So I'll turn it back to you to see if we left any time for questions.
Well, we didn't leave a whole lot of time, but there was a lot of information to cover. You guys, that was amazing as always. We did get a couple questions that came in. Maybe we'll just go a couple minutes long. One of the things actually, so this is a question I had for you guys. You're talking about, hey, where to get started, make sure your data is good. But for those high performing practices, I mean, we all know you can track too much, you can get paralysis by analysis. Where do you guys think, what's the right number for the number of KPIs a high performing practice should be tracking?
I'll start, because I think we have an opinion on this. I'd say a minimum of 3 and maybe no more than 5. Go to 3 to 5 to start. And then once you feel really good about those and how you're tracking those and how the needle is moving, then move on to the next 3 to 5.
Yeah, I think Andy mentioned this a couple of times. Having your financials in proper form and formatting, you can easily visit KPIs at will for maybe 8, 9, 10 of these if you really want to. So just having that to reference can be helpful. But to start, maybe somewhere between that 3 to 5 and kind of see where that takes you. Cast a wider net if you need to, drill down if you need to, until you're really comfortable with your numbers.
Okay, and yeah, please chat in questions if you have them. One of the questions that came in as you guys were talking, it kind of goes into what you're talking about now, Nate, is somebody asked, when do you recommend practices should have their previous month's books closed by? I don't know that that's a KPI, but that sort of determines the data that you have, right?
Correct. I think there's a couple different processes we see with month ends. We've got some folks that have really embraced some of the accounting technology like QuickBooks Online that offers a lot of automation to help bring data in, at least preliminarily, immediately. And sometimes, depending upon the quality of that, sometimes that's enough to start getting these insights. Sometimes logistically, clinics, by the time you get credit card statements, bank statements, those sorts of things, it can take a week to 2 weeks to manually get everything where it needs to be. But if you're really looking for relevant, up-to-date data, sometimes using automation, linking your QuickBooks or whatever software you use to your bank and credit card feeds can be really helpful to at least get you started almost immediately after month end. And that can sometimes be the most helpful information you have. So really, logistically, it depends on the practice, anywhere from 1 to 3 weeks, but it could be immediate to get 90% of the data where it needs to be.
Right. Okay. Thank you. So a couple more questions that have come in, but they're very sort of practice specific. Maybe we can just reach out to those folks directly afterwards. But you guys, great work. So much good stuff as always. Really, really looking forward to next month. But as we wrap up, I just want to let everybody know you can go to sva.com/vet series to sign up for the other webinars in the series. You can also find news and information that may affect your practice. So that next webinar is November 14th. And that, as Nate mentioned, as we've talked about a little bit, that's when we're going to be revealing the results of our second annual veterinary salary and benefits survey. So definitely one you're going to want to sign up for, because we're giving you a lot of the answers, a lot of the KPIs maybe that you're going to want to be looking for. So it'd be really easy to take that information and compare it to your own practice. So I just want to remind everybody, the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA contact as questions arise. And if you're not currently an SVA client, contact me or John Armstrong in our business development group, and we can get you the help or the answers that you need. Andy and Nate, thanks again, guys. It was great. Thanks for attending, everybody. Hope to see you with those next webinars, and hope you enjoy the rest of your afternoon. Bye-bye.